In today's episode, I'll talk about two interesting stories. In the first story, I will discuss if India's economic growth is as stable as it seems from the outside. And in the second story of the day, I'll talk about India's 15,000 crore rupee green steel mission and what it really means for us as investors and our country. Welcome to the Daily Brief show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to traditional news channels. I am your host Anurag Bansal, and today is Thursday, the 2nd of January. Let's start with the first story and talk about India's economy. Look, India's economy has been at the center of attention as of late. On one hand, its growth story for 2024 has been a positive one, and the outlook for 2025 seems pretty promising. Strong fundamentals, resilient financial institutions, and companies with healthy balance sheets have all in a way contributed to this optimistic narrative about our country. But the thing is, if history has taught us anything at all, it is this. When things look too good to be true, it is usually wise to check what could go wrong. And that is why in today's story, we decided to dive deeper into RBI's latest Financial Stability Report or FSR report. Now, you can think of this report as almost like a stress test for India's financial system, which is a comprehensive checkup on how banks, households, and the entire markets are doing in general. Now, what we as a team found was a pretty mixed bag to say the least. There are reasons to feel secure, but there are also some reasons to be a little cautious. So let's break this down step by step and explore the three key risks that could shake India's economic stability if it is not carefully managed. Risk number one that I'll talk about today is household finances. Household debt in India is growing. It is at 42.9% of our GDP, and it is still lower than in many other emerging markets where it usually hovers between 50% to 60%. Now, at a first look, this seems pretty manageable. But the catch here is that India's household debt has been climbing steadily over the last 3 odd years, even while other emerging economies have seen their debt levels drop. And let me tell you that the rise in household debt is not because people are borrowing bigger amounts. Instead, it is the sheer number of new borrowers that is driving this trend today. And this signals greater credit penetration, which is a great sign because it shows that more and more Indians are getting access to formal lines of credit. But the real question that needs to be asked is, what are these loans being used for? See, there are three main categories. Consumption, which include personal loans, credit cards, loans for consumer goods, etc. Second is asset creation, which is home loans, vehicle loans, etc. And the third one is for productive purposes like agriculture, business, education, etc. Now, while consumption loans have not spiked drastically as such, they are still creeping up slowly. And this suggests that households are borrowing not to really invest in assets or businesses as such, but to actually cover everyday expenses. And that is exactly where things get a little tricky. If you look closer at the type of borrowers, the contrast here is pretty evident. First, there are subprime borrowers, which are those borrowers who have a low credit score and they allocate nearly half or 48% of their loans to consumption. To give you a comparison, wealthier or low-risk borrowers, which are super prime borrowers in categorization, use just about 31% of their debt for consumption, and they focus more on asset creation like buying homes. Now, this divide over here matters quite a lot because loans for consumption do not generate returns as such. Now, if subprime borrowers face repayment troubles, the risk could become really bad. And on the other hand, super prime borrowers are borrowing more than ever, but they are still putting their money into assets, which eventually makes them less risky overall. So the question here is, how sustainable is this trend? If subprime borrowers start to default, it could dent household financial stability and could lead to broader economic ripples. The second risk I'll talk about today is the stock market. Now see, India's stock market has had a fantastic run in the year 2024. By the end of September, it hit record highs before it pulled back slightly. Now even with this particular correction that I'm talking about, India has outperformed most of the emerging markets. The MSCI India Index delivered a massive 19.5% return in the year 2024, which was far above the 8.3% return of the MSCI Emerging Markets Index as a whole. Now, mid cap, small cap, and micro cap stocks had led the charge over here. They delivered returns over 30%, which is far higher than the 17% annual return of the Nifty 50 index. But the issue here is that the surge in smaller stocks was not really driven by actual earnings growth. Instead, it was actually driven by investor enthusiasm and risk taking abilities. If you dive a little deeper into RBI's report, they say that while the Nifty 50's gains were tied to real earnings growth, mid, small, and micro cap stocks relied heavily on investor sentiment in the other hand. So, if you put it in simple words, high valuations over here are actually built on hopes for future growth rather than current performance. And this definitely poses a big risk. If investors become more cautious or if the market sentiment suddenly starts to shift, smaller stocks could see sharp corrections because their valuations are not really backed by proven earnings. And after the recent pullback, equity valuations across the board, especially in small and mid-cap segments, remained stretched, to be honest. And this problem becomes a little more evident when you compare the earnings growth with valuation expectations. To give you an example, the Nifty 50's earnings growth is expected to remain below 10%, but valuations assume that it will hit 14% or more. And for mid and small cap indices, this gap is even wider, and it makes them particularly fragile if growth does not keep up with expectations. There is also supply-demand imbalance in a certain sense. See, especially since the pandemic, demand for equities has exceeded the supply of new shares from IPOs and other sources. SEBI's Anant Narayan had warned that this prolonged mismatch could lead to asset price inflation, which is when stock prices rise without contributing to real economic growth. And that is something that we risk seeing today as well. Moving on, the third risk I'll talk about is the banking sector. See, India's banking sector has shown some remarkable improvement over the last few years. Just 1 year ago, several banks were struggling with vulnerabilities across multiple risk indicators. And today, only 3 banks, which account for about 15% of the system assets, remain under stress. That is progress for sure. But the thing is, challenges persist over here as well. One major shift in banking today is the deposit mix. Low-cost CASA, which is short for current account saving account deposits, are declining while term deposits are taking their place. Now, term deposits now form 82% of all new deposits, and banks are increasingly relying on high-cost funding instruments like certificate of deposit. What does this mean for banks, you might ask me? See, rising fund costs are eating into their profits. Since March 2022, banks' cost of funds has risen by 148 basis points, and this has put pressure on net interest margins, which are also starting to shrink. But still, interestingly, return on equity and assets have improved over here, which shows that banks are still somehow managing to stay profitable. But the real concern still lies in asset quality. See, overall, the gross non-performing asset or NPA ratio is at a 12-year low of 2.6%. Now, on paper, this looks great. But if you dig deeper a little bit, you will realize that retail loans are a growing area of worry. To give you an example, over half of all new NPAs in retail loans have come from unsecured loans like credit cards or personal loans. For private sector banks, write-offs of bad loans are rising, which may be somewhat masking the true extent of the problem. Early warning signs like SMA or special mention account loans are also flashing yellow, to say the least. Now, these loans overdue by 30 or 60 days are increasing, especially amongst the large borrowers. Now, if these turn into NPAs, it could become a big trouble for the banking system. So the bottom line over here is that all of it is a bit of a mixed picture. India's economy is at certain crossroads because at one hand, it is supported by strong fundamentals, resilient financial institutions, and growing investor confidence. But on the other hand, there are clear warning signs. Like I said, there are rising household debts, there is a stretched stock market valuation, and there are brewing vulnerabilities in the banking system. Let's now move on to the second story of the day. The Indian government has announced a 15,000 crore rupee green steel mission, which is a step towards transforming one of our country's most polluting industries, which is the steel sector, into a more environmentally friendly powerhouse. Now see, steel making is at the heart of India's industrial economy, but the problem is that it is also a big source of pollution for us. So therefore, this mission is a part of India's larger effort to address climate change, reduce greenhouse gas emissions, and also align our industrial policies with global sustainability trends. So the question is, what is exactly happening over here and why should someone like you or I care? See, India is the world's second largest steel producer, and the steel industry is very critical for infrastructure, construction, and manufacturing. But the traditional method of making steel, which usually involves cooking coal in blast furnaces, produces an enormous amount of carbon dioxide. To put it very simply, coking coal is a type of high carbon fuel that burns to generate the extreme heat that is needed to melt iron ore and convert it into steel. And this process makes steel making one of the largest industrial contributors to climate change, and it accounts for about 10 to 12% of India's total greenhouse gas emissions. And India's reliance on coking coal comes with a big challenge. We import most of it, mainly from Australia, despite having significant reserves of iron ore. And this dependency on fossil fuels not only increases emissions, but it also makes steel production more vulnerable to the global market's fluctuations and supply chain disruptions. And that's not even it. The biggest issue is that as India's economy grows, so will the demand for steel for obvious reasons. And therefore, this means that the industry's emissions could absolutely skyrocket if no changes are made today. And thus, the Green Steel Mission is the Indian government's answer to this big crisis. The aim here is to clean up steel production by using renewable energy sources like solar and wind, and also by integrating green hydrogen into the production process. Now, green hydrogen is produced by splitting water into hydrogen and oxygen by using electricity from renewable sources. Now, unlike coking coal, green hydrogen does not release carbon dioxide when it is used, which makes it pretty much like a game changer for heavy industries like steel. Now, the government's mission also involves mandating the use of green steel in public projects. Green steel, for your reference, refers to the steel that is produced with lower carbon emissions through processes like hydrogen-based steel making or renewable energy integration. Now, this mandate is expected to create domestic demand for green steel and also incentivize companies to invest in cleaner technologies. In addition to this mission also encourages innovation and investment in new technologies and ensures that this sector becomes a lot more sustainable over time. But the question here is, why is the government really doing this right now? See, this timing is linked to several global and domestic factors. First, there is growing international pressure. The European Union is rolling out something called the Carbon Border Adjustment Mechanism, or the CBAM. Now, this is essentially like a carbon tax on imports which includes steel based on their carbon footprint. Now, the CBAM is set to take full effect by the year 2026, and it means that steel exported to the European Union from carbon-intensive countries like India could face heavy penalties or even lose market access altogether. And this is a big deal because Europe is one of India's biggest key markets for steel. In the financial year 2023, Indian steel makers had exported around 6 million tons of steel to the European Union. And without transitioning to low carbon methods, these exports could become too expensive due to additional costs imposed by the CBAM. So therefore, adopting greener technologies is not just about saving the planet for us, it is also largely about staying competitive in global markets. And that is why investors like you and I should really care about this change. Also, domestically, India has pledged to achieve net zero emissions by the year 2070, which was announced in COP26 Climate Summit. Now, achieving this goal requires massive reductions in emissions across different industries, especially in heavy emitters like steel. Now, this green steel mission that I'm talking about is a massive part of that particular strategy. Of course, this transformation will not be cheap. For steel makers, shifting to green production methods will require significant amount of investments. New plants will need to be built or existing ones will need to be upgraded, all of which could be financially challenging for smaller producers. But the government's push could turn this into an advantage for larger players like Tata Steel and JSW Steel. These companies are much better positioned to adopt to new technologies, gain a competitive edge in exports markets like the European Union, and also meet growing domestic demand for green steel. And interestingly, like I mentioned a little earlier, this mission also largely reduces India's reliance on imported coking coal, because as green hydrogen and renewable energy take center stage, India could move closer to energy self-reliance. And this transition creates a lot of opportunities for renewable energy companies and green hydrogen producers, while also encouraging innovation across different industries. With that, let's move on to the final section of the day and talk about the quick news tidbits. First, NPCI extended the 30% UPI cap deadline to December 2026 and removed WhatsApp Pay's user cap, which enables it to serve 500 million users. Now, this comes because UPI transactions have surged 32% in 2024, with PhonePe and Google Pay dominating market shares. Second, Autumn and Mahi Madhusulam Kela acquired a 72.8% stake in Pratap Snacks, which is the maker of yellow diamond chips. Now, the snack market in India is largely fragmented, and therefore, this move will boost Pratap's market position and also highlights consolidation in affordable FMCG. Third, Blinkit introduced a fleet for bulkier orders and EMI options for purchases above 2,999 rupees. The aim here is to boost demand for high ticket items and to expand its customer base along the way. That's all the news and stories I have for you today. I hope you enjoyed this show and maybe learned something new from it today. As usual, this is your host Anurag Bansal signing off. I will see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.